Okay, hello everyone, and welcome to the third video in this series about financial planning or retirement planning. The first video, as you will recall, discussed the Social Security system and focused on how formulaic payouts are determined under that system, which are based upon earnings during a 35-year look-back period and on payout ratios that include 90% payout, 32% and a 15% payout. Then in video number 2, we put together an overall retirement funding plan. And we had 3 component parts that we talked about. So we built upon the earlier discussion about Social Security. So that was the first component. And then we talked about an IRA or 401k plan. And then lastly, we talked about developing a contingency fund that would be available to take care of unplanned emergencies and so forth. Today we're going to talk about managing the 401k plan or the IRA plan. And the intent here, of course, is to, over one's working career, build up a balance in that 401k or IRA plan that meets the financial plan that we talked about in the second video. And one of the questions that we should deal with at the outset is why a 401k or an IRA? Why is that vehicle the right place to accumulate wealth for retirement? And the simple answer is because it's the ideal vehicle for that purpose. It is tax advantaged like no other alternative. So this video, like the first 2, are targeted at my kids, or more specifically people around 40-ish. And people around 40-ish have ample time to adjust all of their savings habits and all of their planning to accumulate enough wealth that they can have an enjoyable retirement. So it seems to me this is the optimum time to be talking to this specific audience. And to that end, we can talk a little bit about the time value of money. So the time value of money is an idea that says the growth in wealth over time is really a function of 2 things. One is simply the amount of time, because money compounds over time based upon some yield rate. And so that second variable is the yield rate. So time and interest rate, or time and yield, those are the 2 variables that determine the rate at which an investment will gain value over time. The difference between 401k and an IRA is that a 401k is an employer-sponsored plan and an IRA is a personal plan. Mechanically, they work very, very similarly. The main difference that's likely is that the 401k plan involves some employer contribution. And if the employer does provide a contribution, then it's certainly to your benefit to make sure the employer's contribution is maxed out. So get all that you possibly can get in the employer contribution. So we'll make these periodic contributions as we are able to do. And then we have to figure out what kind of investments inside of the 401k or the IRA we want to put the money into. And so there are just 2 big classes of investments that we will consider. One is stocks and the other is bonds. In my thinking, there really are no other classes of investments that are worthy to be inside of a 401k or an IRA. So stocks and bonds. Now, stocks are generally understood to be riskier than bonds. That is to say, the volatility, the uncertainty is greater. On the other hand, the yield on stocks tends to be higher over time because there is this positive association between risk and return. So for that reason, we expect to get higher returns over our lifetime on a stock investment. But having said that, we don't want all of the volatility that stocks bring us, so we are going to blend our investment in stocks with some investment in bonds. Now, bonds are not without risk. The value of a bond is particularly susceptible to the effects of inflation. So if inflation goes up, the value of a bond goes down. So the desirable part of the investment in the bond is that the rate of return is essentially fixed by the coupon rate. So whatever the interest rate is on those bonds, that is the return that you can predictably rely upon. But it is to be understood that the value of the bond itself also goes up and down, and that has an impact on return. So if interest rates rise, the value of the bond will go down, particularly if it's a long-term bond. If it's a shorter-term bond, the effects of interest rate fluctuations is muted compared to the effect on a long bond. So we're going to target for 60% stocks and 40% bonds. That's a good ratio in accumulating wealth when you are in your early 40s, late 30s, in that time frame. Now, in a 401k or in an IRA, we have a choice as to whether we're putting pre-tax or after-tax dollars into the account. If you are talking about a Roth 401k or a Roth IRA, what that means is you're putting after-tax money into the plan. So you are paying income taxes on the earnings. You're then taking your after-tax earnings and you're putting them into the plan. On the other hand, a regular 401k or a regular Roth plan, a regular IRA plan goes in pre-tax. So it saves you in the amount of taxes you pay today because it works just like a tax deduction in terms of your federal income tax return. So let's talk briefly about, do you want a Roth type plan or do you want a regular type plan? The answer depends critically on what your tax rate is today versus what your tax rate will be in the years when you retire. These days, especially after the tax reform that we just had in late 2017, the Roth looks more attractive. So the recent tax legislation has lowered tax rates. That makes the Roth more attractive. If you're looking at a high tax rate in your working years, that makes the regular IRA or the regular 401k more attractive. I think ideally, if you can do it, you have one of each. You have a Roth type plan and you have a regular type plan. But where tax rates are today, the Roth looks more attractive than it's ever looked before. So we're going to put 60% of our assets into stocks, 40% of our assets into bonds inside of the 401k or the IRA. It makes no difference whether it's Roth or regular, our investment strategy will be the same. What stocks do we pick? What bonds do we pick? That's the next big question. Well, so we want to buy fund groups. So we want to buy mutual funds, or more desirably, we want to buy what's called an ETF, an exchange traded fund. The difference between a regular mutual fund and an ETF is the cost. So the ETF is managed at a much lower cost. So I certainly strongly recommend buying ETFs for bond investments and buying ETFs for stock investments. On the stock side, we simply want to be diversified. And it doesn't take dozens of different mutual funds or ETFs to get there. You can do it with just a few. But do use exchange traded funds or ETFs, not regular mutual funds. Every year you want to rebalance. So returns can cause the value of your account to go up or to go down. And when that happens, although our target might be 60% stocks and 40% bonds, the movement during the year may cause it to be 65-35 or 55-45. So rebalance each year so you're at that 60-40. That's just something you do with your investment advisor, or if you're running your own plan, you can simply do it yourself. Now, inflation is one of our primary concerns, and we spoke about that in one of the earlier videos. But the reason that we don't just buy the lower risk bonds and thereby avoid the volatility associated with stocks is because we need to have an expectation of returns being high enough that they will more than cover the inflation rate. And that's critical. So when we're building wealth, we have to be building real buying power, not just accumulating dollars. So what I'm saying there is that a dollar today is worth so much more than it will be worth in 30 years. Inflation will degrade the purchasing power of the dollar. So not only do we need to accumulate so many dollars, but we need to make sure those dollars have purchasing power equivalent to whatever that standard of living is that we're trying to preserve. And that's why it's critical that we have stocks in the portfolio. Bonds just do not provide enough inflation protection. So let's see. That's the general strategy. We're going to have a diversified portfolio of stocks, a diversified portfolio of bonds. The money's going to be split 60-40. When we get to our retirement years, we won't change that too much. So we might go 50% stock, 50% bonds. But basically, those proportions ought to be maintained even during the retirement years, because even there you have worry about inflation. So that the concern about inflation is a lifelong concern. Certainly we have not seen it here in recent years, but in the late 70s, early 80s, we had inflation rates in the United States in the double digits. Okay, the other thing we'll talk about here is the contingency fund. So we also have to have a contingency fund, and we have to build that. Now, this is going to be a little bit different than building the IRA or the 401k, because we're probably going to do it outside of those tax advantage vehicles. We want to put all the money that we can into those tax advantage vehicles, the 401k or the IRA. But once we have stuffed all we can each year into that, so for instance, we can only put $5,000 a year into an IRA. Any money that we have available to invest beyond that will have to be invested just on our personal account. Or it could be put away for children's educational savings and things like that. But in thinking about our own retirement, there is no other really tax privileged way to do this. So we're going to want to build a portfolio in an account like with Charles Schwab or E-Trade or one of the other online brokerage services. And we're going to follow the same principles as we follow in the IRA. We're going to have a diversified portfolio of stocks and bonds that we will acquire through exchange traded funds or ETFs. And we're going to invest each month or periodically at least into that portfolio. And so over our working life, we're going to maintain that 60-40 split, and we're going to be deliberate and we're going to be consistent in doing that and building that wealth. And so we know what our target amount is in that contingency fund, because we spoke about that in one of the earlier videos. Now, when we get to the retirement years, things will change. We'll want to move those monies to a safer haven. We don't want there to be volatility around that money, because that money exists just to cover contingencies. Okay, so let's do a bit of a recap here. So in our planning for retirement, we are contemplating having two primary sources of income. One is Social Security, and the other is the payouts from our tax privileged retirement account, IRA or 401k plan. And to the extent that we have the ability to influence the assets that are acquired inside of that tax plan, we want about a 60-40 split between stocks and bonds. And we want to rebalance that every year so it maintains at 60-40. We want to evaluate each year where we're at relative to that wealth accumulation goal that we have, so that we will have the standard of living in our retirement years that we hope to have. And if not, then we'll have to make adjustments in terms of perhaps the amount that we're putting in, or think about different investment portfolios if that should be appropriate. All right, so I'm going to do one more of these videos on retirement planning, and the last one is going to be on managing debt. And so managing debt is really no more than managing one's standard of living or managing one's lifestyle relative to one's earnings, but doing that over a lifetime. So we'll talk about all the details of that in the fourth and final video. Hope you've enjoyed this one.